Hi guys, how are you today? Today we are going to discuss some basic facts about the statement of cash flow, which is one of the most important reports to be prepared by a. Why cash in a separate report? This might be a question in your mind when you hear that we have a cash flow statement. As we discussed before during the lecture of the balance sheet, we have seen the cash as one of the current assets in the financial position statement. So why we have to prepare a statement especially for cash? I will tell you the answer. Cash is the most liquid asset and plays crucial role in the business life. Exactly like blood for human body, cash can be used immediately to perform economic actions like buying, selling, or paying debt and meeting immediate wants and needs. Cash flow in and out of the business treasury or bank account the same way like blood flows in and out of the heart. So if this flow is going well, the business will survive and live longer. On the other hand, if the cash flow circulation stopped or hindered at any time, this could represent an emergency case that needs to be treated immediately before the business dies. This is the reason why we prepare a specific report that shows the cash flow of business activities during the accounting period and consider this as one of the main financial reports that we need to provide to decision makers. The purpose of the statement of cash flow is to explain the change in cash balance. How does a company receive its cash and where does a company spend its cash? And the importance of this information is that users evaluate company's ability to pay its debts. Users evaluate also company's ability to pursue opportunities, and managers make long-term investment decisions and plan their day-to-day operations by analyzing this information of cash in and cash out during the accounting period. So someone may ask me if we have an income statement, it might be not necessary to prepare a cash flow, but the answer is no. There is a main difference or a big difference between the profit and loss statement, or what we call the income statement, and the cash flow statement. And the main difference is we prepare the cash flow, the profit and loss statements according to the accrual basis. We match our revenues and expenses in the income statement, even if there is no cash in or out. As we discussed earlier this semester, according to the revenue recognition principle, we have to recognize revenues once we provided service or once we delivered goods to our customers, regardless of when cash is received. And this is the reason why we record the credit sales as a revenue, because it doesn't need to be a cash transaction to be recorded as a revenue according to the revenue recognition principle. Also for expenses, we may record an expense, or we have to record expenses of the accounting period regardless of when cash is paid. If we have electricity bill for the current month and we haven't yet paid this bill, but it's related to the current month, according to the expenses recognition principle, we have to recognize these expenses. So we may have income in our income statement of $1 million, $2 million, but in reality, we may find that there is no cash in the treasury. There is no cash in our bank account because it might be all transactions on account of revenues and expenses reported in the income statement, but there is no cash in or out related to these activities according to the accrual basis. And this is the fact that we need to keep our eyes on the cash balance, because in the cash statement, we follow the cash basis in our reporting. We only report the cash transactions in or out, even if it is not from revenues and expenses, from any other activities provided cash or consumed cash during the accounting period. And relating to activities, the business activities, let me explain to you the types of activities, the business activities types, that the business activities are classified into one of three types as follows. The financing activities, which are related to the business source of finance. If you have a business idea, the first thing you need to think about is how will you get the money necessary to start your business. And of course, many of you knows that the capital and long-term loans are the basic sources of financing the business at the initiation stage. Later on, you may have source of self-financing from the business activities, but we will discuss this later. At the beginning of the business life, you have only two sources of financing your business: capital, owned by or provided by the investors, the owners of the business, and long-term loans from banks and other creditors. Okay, once you get your finance sources or your money, now you need to start the business. So you need to invest this money into different types of assets. Investing activities represents the activities of the money, or the money that you are going to invest to purchase long-term assets such as land, building, equipment, production lines, cars, trucks, all of these types of assets that you need to use in order to run the business. And once you got these assets, you have now the ability to run the business through the normal operating activities or the day-to-day activities. You can now buy goods, you can buy raw material, you can process your business, pay salaries, pay rent, pay advertising, and finally you sell these products or goods and achieve revenues. And these are the operating activities. And you will find these activities related to the current assets and current liabilities in the financial position statement. And this is the reason that the cash flow statement format is divided into three sections. Section 1, to show the information about cash in and out from operating activities. Section 2, to show this information of cash in and out from investing activities. And finally, Section 3, presenting information of cash in and out of activities. Any cash inflow or cash outflow from these activities would be added or subtracted in the appropriate section of the cash flow statement to get the net change in cash balance during the accounting period. Here in this slide, you can find some examples of cash in and out from operating activities. For example, of cash inflow, cash flow from cash in from sales revenue, cash from collections of our customers, cash receipts of dividends revenue or any other source of revenue. On the other hand, the cash outflow will be mainly related to the normal expenses of rent expense, salaries expense, advertising expense, insurance expense, utilities expense, all of these types of expenses. For investing activities, you can find here some examples. Cash flow from selling assets, cash inflow from selling long-term investments, cash inflow from selling intangible assets. You will find that all related to long-term assets, and cash outflow related to buying these assets. So if we buy a long-term asset, this is a cash outflow related to investing activities. If we sell a long-term asset, this is a cash inflow from investing activities. Examples for financing activities include cash in from issuing stocks, cash inflow from issuing long-term loans, long-term debts, long-term bonds, cash in from receiving a long-term bank loan, any cash in related to the sources of financing our business, as we explained a minute before, from the capital or from the long-term liabilities. And cash outflow as well, related to the same categories of capital and long-term liabilities when we pay back the loans to the bank or to the creditors, when we repurchase our stocks, which we call the treasury stocks. All of these transactions represent cash outflow related to financing activities. Let's take this simple example to make it clearer. Here, given the following cash data, cash in and out data, receipts from customers, receipts from asset sales, receipts from stock issuance, and payment for inventory to purchase goods or material, payments for operating expenses like salaries, rent, advertising, payments for equipment purchased, payments for taxes, payment for bonds retirement or pay back the bonds, and payments for dividends to our stockholders or investors. And let's classify these data into the three categories of our cash flow statement. So the first here you can find receipts from customers, receipts from selling goods to customers or from collecting cash from account receivable. And as long as these cash receipts or cash inflow are not related to capital or long-term loans, so it is not a financing activity. It is also not related to long-term assets, like buying or selling long-term assets, building, equipment, cars, any of these long-term assets. So this is not also an investing activity. So we have only one choice now to add this into the cash flow from operating activity. By the same way, receipts from asset sales. When we sell a long-term asset, here when we say assets, we mean the long-term asset, like equipment or old car of the business. And this is related to the long-term assets, which is an investing activity, cash in from investing activity. Receipts from stock issuance. When we issue stocks or capital stocks, we get money from our main source of finance. So this is a cash flow from financing activity. Payments and cash outflows. Payments for inventory, to purchase goods or raw material. This is related to the normal operating activities of the business. The operating expenses, such as salaries expenses, rent expenses, utilities, electricity, insurance, advertising expenses, all of these types of operating expenses are related to the operating activities of the business. Payment of equipment purchased, long-term asset purchased, represents cash outflow from investing activity. And payments for taxes. Taxes related to the normal operating activities. So this is a cash flow from operating activities. Payments for bonds retirements or pay back the loans to our creditors, the source of financing our company, the second main source of financing the company. If you remember, just a minute or 5 minutes ago, we explained that anything related to capital or long-term loans is considered a financing activity. So payback or retirement of bonds means payback money to the bondholders, the creditors. This is an activity which is a financing activity. And payments, finally, payments for dividends. And these dividends is paid to the capital stockholders, which is related to the owners of the business, our main source of financing the company. So this is to be classified as a financing activity, cash outflow. And when you add all of this information together, now you can find the net cash provided or used by each type of activities during the accounting period. And here you can see that we have a positive 65,000 cash provided to the company from its operating activities. But you have a negative 6,000 cash consumed by the company's investing activities, and also negative $17,000 cash consumed in our financing activities. And the net change in cash is 42,000 positive cash inflow. And this is a net increase in our cash during the accounting period. Of course, this information is very important, as we said earlier in this lecture. Investors and creditors need this information for making rational decisions, investment decisions and credit decisions. Investors assess cash flows before buying and selling stocks in order to make sure that the company has the ability of generating enough cash to not be in the risk of bankruptcy later on, and they may lose their money. And creditors also evaluate the company's ability to generate enough cash to pay the debts and the interest on debts in order to make sure that their money is in a safe place. And maybe in another chapter during this semester, we will discuss all of the business information analysis or the financial statement analysis. And here we only provide two of these ratios that investors and creditors use to assess the company's performance. The first ratio is the cash flow on total assets, and this ratio indicates or provides an indicator to the efficiency of using the business assets in generating cash flow from operating these assets, which shows the performance of the business management when compared to other companies of the same size. So if we have a good management team, they can use the assets available to them in order to generate the highest amount of cash from the operating activities. Also, we have another ratio, which is the free operating cash flow to total debt. And this ratio indicates to the company's ability to generate enough cash from its operations to cover and pay back its liabilities, which is a very important indicator for the creditor's decision making. And as I said, these ratios and many other ratios will be explained in more details in a separate chapter later on. Now, this is the end of our lecture today, and in the next lecture, we are going to discuss in more details the different ways and methods of the cash flow statement preparation. We will see that we have two different methods, the indirect method and the direct method, and let us discuss these issues in the next lecture. The questions, if you have any question, please don't hesitate to add your question in the comments below, and I will answer all of your questions. I'm very happy to answer your questions as soon as possible, and to re-explain again any parts of this video. Thanks very much and have a good day. Bye-bye.